Is your credit score's impact on rates universal? Imagine trying to buy a car or a home and wondering why your insurance costs keep climbing. Your credit score might be playing a bigger role than you think. Not all states or insurance types treat credit scores the same way. In some places, your credit score can influence your insurance premiums, but in others, it does not. This variation can seem confusing, but understanding how it works can help you make smarter choices. A credit-based insurance score is different from the credit score lenders use for loans or credit cards. Insurance companies develop these scores to predict the chance you might file a claim. They look at your payment history, how much debt you owe, how long you've had credit, the types of credit you use, and recent credit inquiries. These factors help insurers decide how risky you are as a customer. Most auto and homeowners insurance companies in many states use credit-based insurance scores to set their rates. If your score is high, you might pay less because you're seen as less likely to file a claim. But if your score is low, your premiums could be much higher, sometimes more than double. This can make it harder for some communities to afford insurance, especially if they face challenges building or maintaining good credit. However, not all states allow insurance companies to use credit scores. States like California, Massachusetts, and Hawaii restrict or ban their use in auto insurance pricing. So, if you live in one of these states, your credit score won't impact your rates. The rules change depending on where you live, which means the effect of your credit score is not the same everywhere. The type of insurance also matters. Credit scores are mainly used for auto and homeowners insurance. For life or health insurance, your credit score usually does not affect your rates. Some companies might consider credit indirectly, but it is less common. Your credit score can influence how much you pay, but it is just one part of the picture. Insurance companies also look at your driving record, claims history, the type of vehicle you own, where you live, and your age. Good driving habits and a clean record can sometimes help offset a lower credit score. For Black communities, understanding this is important because systemic issues have historically made it harder to build good credit. This can lead to higher insurance costs, which adds to financial strain. Learning how credit impacts rates and exploring insurance options that do not rely heavily on credit scores can make a big difference. You can start by checking if your state allows credit-based insurance scoring. Review your credit report regularly to see where you stand. Shop around with different insurance providers because they may weigh credit scores differently. Ask your insurer if they use credit scores and how much they matter in their pricing. Improving your credit by paying bills on time, reducing debt, and keeping a mix of different types of credit can help lower your rates over time. Remember, your credit score's effect on insurance rates is not the same everywhere. It depends on your location, the type of insurance, and the insurer's policies. Being aware of this can help you make better decisions and find ways to save money while protecting yourself and your family.